Today I'm looking at chapter 27 of the 1940 edition of Security Analysis. It's one big, thick book. And it's probably more relevant today than when it was written. Because the question Graham is really asking is this: when does fundamental analysis actually help you? And when does it just give you a false sense of certainty? We tend to assume that if we look hard enough at earnings, growth, industry position, we can work out what a stock is worth. But Graham's starting point is much more cautious. He's not really asking whether analysis works, he's asking when does it actually give you a dependable answer. This chapter is about how investing moved from being historically grounded in facts, dividends, earnings, assets, to being almost entirely driven by expectations of the future. And in that shift, the line between investing and speculation didn't disappear overnight, it just blurred. Now, here's where Graham is very honest. He's quoted as saying, "As far as the typical common stock is concerned, an analysis, however elaborate, is unlikely to yield a dependable conclusion as to its attractiveness or its real value." That's a strong statement. He's not saying analysis is useless, but he is saying most of the time it won't give you a clear answer. And then he balances it by saying, but in individual cases, reasonably confident conclusions can be drawn. So analysis does work, but only in certain situations. To understand when it works, he goes back to how investing was done before the speculative boom of the late 1920s. Back then, stocks were treated much more like real assets, almost like buying part of a private business. And he sums it up very clearly. Investment in common stocks was formally based upon the threefold concept of 1. A suitable and established dividend return, 2. A stable and adequate earnings record, and 3. A satisfactory backing of tangible assets. So if you were looking at what does this business earn, what does it pay you, and what is actually behind it, you started with what was there, not what might happen in the future. And this leads into a really important distinction. If your reasoning is mainly about the future, it was considered speculation. Graham puts it simply: speculation meant looking forward. The future was uncertain, therefore speculative. The past was known, therefore a source of safety. Today, we almost invert that. But Graham is reminding us the future is where uncertainty lives. So what changed? Why did this approach stop working in the years leading up to 1929? Graham points to instability. The records of the past were proving an undependable guide to investment. And even more starkly, corporations enjoying decade-long prosperity were precipitated into insolvency. So past earnings stopped being reliable. Assets didn't give the protection people expected. Entire industries could change quickly. So investors shifted their focus. And that shift led to a new idea. The value of a common stock depends entirely upon what it will earn in the future. From that came 3 conclusions. Dividends didn't matter, assets didn't matter, past earnings only mattered as to what they indicated for their trend. And this led to a critical mistake. Price stopped mattering. That was the core error. Graham calls this out very directly. The notion that the desirability of a common stock was entirely independent of its price seemed incredibly absurd. And then The identical reasoning would support the purchase at any conceivable price. That's the core error. When everything depends on the future, any price can be justified. This is the most important idea. A rising trend does not tell you what something is worth. Graham says, there is no method of establishing a logical relationship between trend and price, and the value placed upon a satisfactory trend must be wholly arbitrary and hence speculative. Trend gives direction, but not valuation. Let's look at some modern day examples. Take AI. The business reality is extraordinary. Nvidia generating tens of billions in data center revenue. Palantir is growing 50 to 60% with exceptional margins. But the stocks have fallen, even while the numbers remain strong. Nothing broke, but expectations shifted. And that fits exactly with what Graham is warning about. The notion that the desirability is independent of its price seems incredibly absurd. Same business, different expectations, different price. Now take luxury. Businesses like LVMH are still formidable, massive revenue, dominant brands. But growth didn't just slow, it reversed. China weakened, core divisions contracted. Nothing collapsed, but expectations changed. And the stock reacted sharply, which fits perfectly with what Graham was saying. The value placed upon a satisfactory trend must be speculative. Change the trend and the valuation follows. And EVs. Tesla looked unstoppable for years. Then growth slowed, margins compressed, competition surged. Again, nothing unusual from a business perspective, but from a market perspective, everything changed. And it ties back to what Graham was saying, where the records of the past were proving an undependable guide. The trend was real, but assuming it would continue unchanged, that's where the risk was. The pattern is the same across all three. AI, exceptional growth in margins, expectations shifted from infinite to finite, sharp contraction in price. Luxury, dominant but slowing, expectations shifted from expansion to reversion, sharp contraction in price. EVs, margins compressed, expectations shifted from unstoppable to cyclical, high volatility. The volatility isn't in the fundamentals. The volatility is in the speculation. In closing, the takeaway is simple, but easy to ignore. Fundamental analysis still matters, but it doesn't always tell you what to do. And it definitely doesn't protect you from overpaying. Graham's framing is still the best one. The future was uncertain, therefore speculative. And that's really the dividing line. When your entire case for a stock rests on what might happen, you've already crossed it. You're no longer investing, you're just speculating with a spreadsheet. I'll go through the rest of the chapters in the same way because this framework really builds on itself.